Good morning and welcome to the AUDUSD Securities Markets Update. We'll start again today with a look at the latest developments in the US yesterday before looking at the fundamentals in Asia and the upcoming European and the US session today. Yesterday we noted in our entire reports that we are well prepared for a disappointment from the US Federal or the US, especially from the retail sales, and the outcomes came in contrary to the market estimates. But first of all, the retail sales, or beginning with the retail sales, basically it is unexpectedly declined by or fell by 0.6% in February, despite the fact that the estimates had been anticipated to rise by at least of 0.3% after declining by minus 0.8% in January. And this is the third monthly decline in a row, which we have not seen since 2012. And back then, if we go back to the history, when the retail sales dropped by 3 months in a row, in addition to a drop in the factory orders for 3 months also in a row, the Federal Reserve sparked QE3. In addition to that, secondly, we had the retail sales, or the core retail sales, excluding the autos, or retail sales excluding the autos. It also unexpectedly fell by 0.1% in February, despite the fact that the estimates again pointed to a rise of at least of 0.5%. And moreover, January's reading has been even revised lower to minus 1.1 instead of minus 0.9%, and basically which will lead again to another GDP or another GDP revision to the downside. But this is the third monthly decline in a row, which also we have not seen this or such decline since 2012. Thirdly, the retail sales excluding the autos and the gases also unexpectedly declined by 0.2% in February, while the estimate were to rise at least by 0.3%, and January's reading has been revised even lower to minus 0.1 instead of a growth of 0.2%. And this is the second monthly decline in a row, and which is basically not seen since 2009. Fourth, the month-over-month import price index also increased by 0.4% in February, while it had been anticipated to rise by 0.2%. What's more important is that January's reading was even revised lower to minus 3.1 instead of minus 2.8%. In addition to that, the year-over-year import prices or import price index also fell by the most since 2009, declining by minus 9.4% in January, comparing to the minus 8.9%, which was the estimates. January's reading also has been revised even lower to minus 8.7% instead of minus 8, and this is the seventh year-over-year decline in a row and the worst since the financial crisis in 2008-2009. In addition to that, we had the business inventories came in also unchanged in February, while the estimates pointed to a rise of 0.2%. Moreover, January's reading also was revised lower to no change instead of a growth of 0.1%. Meanwhile, and after these figures, or after these numbers, after these outcomes, it led to a dramatic declines in both Bloomberg and Citigroup US Economic Surprise Index. First of all, the Citigroup US Economic Surprise Index collapsed to minus 55.6, and this is the biggest decline since 2012. In addition to that, the Bloomberg Surprise Index collapsed to the most since 2009 toward minus 63, which basically, and during the financial crisis it was almost minus 1%. However, we maintain our negative view on our negative outlook for the US dollar, but however, this doesn't mean that we are selling the US dollar. The US dollar outlook remains bullish until the Federal Reserve surprise the markets or surprise us in June or maybe next week with no rate hikes or a change in the tone from hawkish to dovish again. Yesterday, the US dollar eased some of the gains after the news. However, the rally resumed during the session as the market is still believing that the Federal Reserve will raise rates in June. Going forward to the Asian session today, there were two economic releases from New Zealand and Japan. However, both had only a slight impact on the market. In New Zealand, the business manufacturing index advanced toward 55.9 in February, up from 50.7 in January, which is also the highest reading since December of last year. In Japan, the industrial production, or the revised industrial production, also for the month of January has been revised lower toward 3.7% instead of 4%. However, it remains the biggest monthly increase since January of 2014. Going forward to the European session today, we will be waiting only for one economic release from the UK. The construction output is expected to rise by only 1.4% in January, comparing to a rise of 0.4% in December of last year, which would be also the biggest monthly increase since September of last year. As for the US session today, there are a collection of economic releases from Canada and the US, which is likely to have a major impact on the markets again. But beginning with Canada, the jobs report will be, or for the month of February, will be released today, and the estimates are lower. The employment exchange is expected to decline by 3.5% in February, comparing to a rise of adding around 35.4 thousand in January, which would be also the first decline since December of last year. Moreover, the unemployment rate is expected to tick higher towards 6.7 in February, up from 6.6% in January, which would be also the highest reading since December of last year. In the US, which is the key for today, again, there are many economic releases today, which likely to have also another major impact on the market. But beginning with the PPI, the estimates are to rise again by 0.2% in February after a decline of 0.8% in January, which would be the first increase after 3 months of consecutive declines. The core PPI is also expected to rise slightly by 0.1% after declining by 0.1%, or the same rate during the same period, which would be also the biggest increase in almost 2 months. Finally, the initial reading of University of Michigan Consumer Confidence or Consumer Sentiment Index is expected to rise again toward 95.6 in March, up from 95.4 in February, which would be also the highest in 2 months. But again, we are well prepared for another disappointment today. Quick update on the charts that we showed you yesterday. This was the Aussie yesterday, and we were expecting the pair to enter a new selling area between 76.22 and 76.37 with stops above 78.90. However, the pair continued to rise today or yesterday towards 77.10 before declining again. So therefore we were stopped out. However, we have a new selling area between 77.04 and 77.37, while the stops right now is higher at 78.46. So far, the pair already entered the selling area during the Asian session and during the US session yesterday, and declined back down towards 76.78. So if you're still interested in short, you can go short with a stop above 78.46 or 78.50 with and we're still looking for another dip lower to or below this week's low or last week's lows around 75.61. Going forward to the Kiwi remains within the same selling area that we noted yesterday between 74.01 and 74.50, and yesterday the pair also rallied toward this level, or toward the same area, which is 74.01 and 74.51. Yesterday's high was around 74.48, which basically around like 3 pips away from the second selling area. But since then, the pair also collapsed back down to 73, or declined to 73.68. So we're talking about almost a 50 or 40 to 50 pips. So far, the stops remains above 76.10, and we're looking for another decline back below 71.92, which is this week's low. This is it for today. You can follow us on our social media sites, Twitter, Facebook, and YouTube, to get the latest economic releases, reports, and analysis. And if you also like this video, you can like it on YouTube, you can like it on Facebook, and you can also subscribe and share it. Thank you for watching. I'll see you once again next week.